topics for the half semester. International. Okay. Okay, so don't underestimate the importance of these topics. Okay, just because they're at the end of this half semester, that doesn't mean that they're not important for learning, and less important than that is for the final exam. Exams are important to you, but these topics are extremely important to inbound investment in the United States. Very troublesome issues for those companies investing into the United States. Okay, so interest expense limitations. So what we're looking for is interest expense that has been lent from the foreign parent group into the United States subsidiary. So some kind of startup, investment, CapEx, expansion, whatever, but the U.S. needed money and the foreign parent group got the money to the United States by lending the money. Okay? The importance of what that means is because then you can repatriation of the U.S. corporation earnings to the foreign shareholder can be accomplished by two means. Either a dividend, okay, and a dividend distribution is not deductible in computing U.S. corporate income tax liability and may be subject to U.S. withholding tax, right? We don't deduct the dividend in arriving at taxable income in the United States. The dividend comes out of after-tax earnings, right? Contrast that with interest or any other deductible payment from the United States as a foreign parent. The payment of a deductible expense, by definition, by a U.S. corporation reduces its U.S. corporate taxable income and may be subject to a relatively low rate of withholding tax. Okay? So we have a dichotomy between the two ways to get the funds from the United States to the foreign parent. So automatically you would think, I'm inclined to get my money out of the United States via a deductible payment. So I pay less tax, right? Rather than not have the deductible payment and rely on dividends, which are not deductible in arriving at the taxable income. We're going to be talking about the U.S. side of this, but I'm going to continue to point out you need to think about the foreign side of this as well. Okay? The foreign tax implications of receiving dividends, if that's your choice of repatriation of U.S. earnings, is likely exempt. Remember what we talked about early on with tax jurisdiction? Most of the rest of the world is a territorial jurisdiction. They do not tax earnings that were earned outside their country of incorporation. So a foreign jurisdiction receiving dividends from a different country probably don't tax the dividends. That's beneficial, even though it's not deductible for U.S. purposes on the payment side, but on the recipient side, not includable and taxable there. Whereas if you decide to repatriate, with interest, that's likely taxable. I don't know of any country that does not tax interest income. Okay? So it might be deductible in the U.S., but it might be taxable in the foreign country. So you can never do international tax planning in a vacuum. Not just look at what is the U.S. result and what's best there. You have to layer on what happens on the other side of the transaction. I thought that was one of the attractive points of international taxation when I was practicing, is the cross-border nature that, by definition, meant you had to work with another team. And what you're trying to do is balance the two implications. Okay? So we're going to compare and contrast the dividend versus an interest payment, but again, keep in mind that you have foreign implications on the recipient side as well. Okay, 1029, did anybody volunteer for 1029? Anybody want 1029? Case 1, first part. No. Okay, 1029. So Forco is the parent. So down at the bottom, you see the we have a foreign parent investing in the United States via a U.S. subsidiary, USACO. Owns 100% of USACO, a U.S. corporation that derives all of its income from U.S. business operations. During the first year of operation, USACO has taxable income of $10 million. Assume the U.S. corporate tax rate is 21, and that the applicable treaty withholding rate is 5% for dividends and 5% or 0% for interest. So we have a treaty between four coast country tax residency and the United States. That treaty lowers the 30% statutory withholding tax for dividends down to 5, takes the 30% statutory withholding tax for interest down to 0. Okay, so that's the facts we're working with. So our first case is we want to look at what if we repatriate our earnings from the U.S. via a dividend distribution. So that's the only mechanism that we can get money out of the United States to the U.S. because there's no other transaction, right? Meaning that there's only equity between Forco, sorry, things not advancing. Forco and USACO, there's only equity. Okay, so given the 21% U.S. tax rate, USACO pays $2.1 million of U.S. tax on its $10 million of taxable income, leaving $7.9 million of cash remaining, and it makes a dividend of that distribution to Forco. So you'll receive a $7.9 million dividend, but you incur $395,000 of U.S. withholding tax, $7.9 million times the 5% treaty withholding tax rate, right? Therefore, the total effective tax rate on U.S. tax on USACO's repatriated profit is 24.95. The $2.1 million of corporate income tax and the $395,000 of withholding tax to get the money out of the United States in the hands of the foreign parent. Okay, so that's it. We have we fully equity finance the U.S. subsidiary to get it started in any future funding. So if we compare and contrast that with case 2, let's say we have lent them money in the past. You lend money, the creditor gets compensated via interest, right? So now I have two options I could pay. I could pay interest or I could pay a dividend. Either or, right? So now assume that Forco has a bona fide creditor interest in USACO. We'll talk about what that bona fide creditor relationship means in a moment. But that just means there's a real loan in place between the two parties. And USACO makes annual interest payments of $10 million to Forco. Ignoring the anti-earning stripping provisions, that's the rule we're going to be talking about here. So ignoring any limitations on interest expense. Assume all interest expense is deductible. The $10 million of interest expense would reduce USACO's net taxable income and tax liability to 0. Right, because I have $10 million of income, I get a deduction of $10 million, assuming no limitation on my interest expense, leaving taxable income of 0 on the U.S. tax return. So I do not incur any U.S. withholding tax on the interest because the treaty has a 0% withholding tax rate on interest between the two countries. As a result, if I repatriate my USACO earnings via interest expense payments, rather than a dividend distribution, I'm able to reduce my total effective tax rate from 24.95 in case 1 down to 0. Okay, I put over here the box on the right. This is an extreme example, right? Because you can't go that extreme. They're just the authors are just trying to depict to you how effective repatriation via deductible payment could be. But the rule we're going to talk about in a moment is always going to limit interest expense to a percentage of your earnings before interest, taxes, and depreciation. Okay, so remember, all other things being equal, a foreign parent might like to finance their U.S. subsidiary with debt because now they can repatriate via deductible payments as opposed to dividends. Okay. The foreign tax implications, you have to think about that as well. Case 1 would have been dividend income to the foreign parent, likely not taxable. Case 2 would have been interest to the foreign parent, likely taxable. Okay. You need to understand what that is and balance that as well. And you may not know that as the U.S. advisor on that because you don't know the tax profile of the foreign parent. What if they're running losses? Interest income may not be a problem for them because they don't have taxable income. You can offset it with the losses in the jurisdiction. You don't know the tax rate necessarily that they're paying on the interest. So yeah, that's where you have the two offices working on the same project. Okay. So the background for interest expense limitations. Historically, Congress was concerned that foreign shareholders. I'm going to try this. Give me a second here. This works. It annoys me, and I know it annoys you. Okay. So historically, Congress was concerned that foreign shareholders would finance its U.S. subsidiary with excessive debt. I put that in italics because that's a subjective term, like how much is excessive debt financing for a corporation. Would finance its U.S. subsidiary with that excessive debt such that the resulting interest expense would erode U.S. taxable income inappropriately. So they enacted rules to govern the degree to which such interest expense is deductible. Okay? So we were mainly focused on the inbound context of over-leveraging a U.S. subsidiary for the reasons between that difference of case 1 and case 2, lowering the U.S. taxable income. Okay? And that was a real problem when the U.S. pre-Trump 1.0 was 35% tax rate instead of 21. Right? If you could finance a high tax jurisdiction with debt, the interest expense lower that taxable income, that was very appealing around the world. So pre-2017, all foreign parents were really focused on driving down the U.S. tax liability because the tax rate was so high. In the Tax Cuts and Jobs Act of 2017, Trump 1.0, interest deductibility limitations were greatly expanded. So not just the foreign shareholders, but now they apply to all payments of interest by a U.S. corporation, whether paid to a foreign shareholder or any financial institution, foreign or domestic. So I'm just giving you a little background here because previously, pre-2017, we only were interested in interest expense paid to a foreign shareholder. What did they do in the Tax Cuts and Jobs Act? Main thing, we dropped the 35% rate down to 21%. One of the ways they raised revenue to offset that loss in revenue was they expanded the interest expense limitations to all payments of interest and not just to related parties. Even a U.S. company that's a U.S. parent that borrows from a bank, they are subject to 163J, which is the statute we're going to talk about momentarily for the interest expense limitation. Pre-2017, it was only if you were an inbound and you had borrowed from your parent. External loans were not caught. Okay? So for 2025, the limitations on the deductibility of interest expense only apply to U.S. corporations that averaged at least 31 million of gross receipts over the prior 3 years. Remember our definition of small businesses? The definition of small is objective. It was looking backwards over the prior 3 years. You have 31 million average gross receipts. If you're a small business by virtue of that definition, you're outside of these rules. Okay? But everybody else is in these rules. Okay? The first thing you do when you see a related party loan is you first have to make sure that it is in fact debt. Okay? Because when I give you a related party fact pattern, you guys are seasoned tax people now, you've been in several tax classes, you're going to be skeptical of whether is that really debt. Because related parties do things differently than they would with unrelated parties. Okay? So, a bank, when they're making a loan, what do? They scrub your financial statements, they make sure they look at your projections, they look at other debt that you may have, and then they price the debt, i.e. the interest rate, the terms accordingly. Right? But there's a degree of regulation, if you will, around that relationship between the creditor and debtor when it's an external financial institution. Related parties don't do that. A foreign parent that has a U.S. subsidiary, you don't go through the same process to make the loan. You just don't. Me giving a loan to my daughter, I don't go through the same process as if I was going to loan the money to you. Right? Human nature. So, the first thing we have to do is make sure that the purported debt is in fact debt and is not truly equity. Okay? And that is a determination based on U.S. case law. So, this is the first step you do. When you see a loan, it's like, is that debt for U.S. tax purposes? And the IRS has the ability to characterize purported intercompany debt as equity in certain circumstances. Numerous factors have been given rise over time in case law. So case law is court cases, because this has had a long history, decades long, of advances from one related party to another party that the parties call debt, but the government is concerned is not truly debt, and it's more like equity, because they're concerned that the parties are just trying to get the interest payments. Somebody's trying to get a deduction. So some of the factors is the name of the instrument, the interest rate, the cash flows of the borrower. Are they sufficient to make the payments? The debt equity ratio of the borrower, the interest coverage ratios, everything that a banker would look at when they're advancing money to somebody as a creditor. That's what the case law has developed. So if you've got a U.S. subsidiary that is losing money and has external debt already, and you purport to lend them more money, the government just doesn't take your word for it that it is a loan. Because they will look at it and say, would a third party, would a lender, a financial institution loan that money to that particular borrower on their profile? Okay. The IRS can also, in the bottom note there, can also adjust the interest rate on intercompany debt to an arm's length interest rate via application of the transfer pricing rules. Right? If I lend money to my daughter, I might give her a sweetheart interest rate that I wouldn't give you. Okay? The IRS holds related parties to giving market rates of interest. Okay, so they can adjust the instrument between debt and equity, and they can also adjust the interest rate. So I have to first do that. If I first say it's debt, and then I am comfortable that the interest rate is an arm's length interest rate, now I am into the interest expense limitation, which is how much of that do I get to deduct for U.S. tax purposes. One other topic I should have covered first. The timing of the interest deductibility. So a U.S. corporation owing interest to a foreign related party is not allowed to deduct interest expense under the accrual method. It's just a peculiarity in the U.S. rules. Remember, corporations are on the accrual method, unless you're a small business and then you can elect to be on the cash method. Let's assume we're a sizable U.S. corporation. If I'm paying interest to my foreign parent group, then I cannot deduct that on an accrual basis. Flat out. The U.S. puts me effectively back on the cash method for this sole purpose of this payment stream. Whereas if I have the same group structure, foreign parent, U.S. subsidiary, but U.S. subsidiary borrows from a bank, that interest is deductible on an accrual basis, just like any other expense. They just put me, because of that related party nature, they want me to make the payment before I can deduct it. Okay? So the reason I do slides 31 and 32 is, first I got to determine whether it's debt or equity. Then I got to make sure the interest rate is right. Then I got to pay the interest. Now I have live, if you will, live interest expense that I can test against the limitation. calculate the deductible interest expense, that is 163J. I don't give you a lot of code sections, but I can guarantee you a company that has a limitation, the CEO knows 163J. Because it is a complete headache for the company. Because what is happening? If I am limited under 163J, my effective tax rate goes up as a corporation. Why? Because I have an economic outlay for interest, because I do pay it. I do incur the interest expense, but it's not fully deductible. That's going to cause my effective tax rate to go up. I guarantee you, CFOs and CEOs do not like answering that question on analyst calls. Why is your effective rate higher than XYZ competitor? You have to tell them, well, we have an interest expense limitation and we can't fully deduct our interest expense in the current year. And then when they're done with the call, they call the tax department and say, can we fix this? So 163J, important code section. It limits the interest deductibility. So since 2018, the interest expense limitation again applies whether the interest is paid to a related or unrelated lender and whether it is paid to a foreign or domestic lender. Thus, the limitation now applies very broadly. It applies to every U.S. corporation. Now, not every U.S. corporation you'll see has the limitation. They're not limited, but it is applicable to them. Okay? The deductible interest expense is limited to 30% of adjusted taxable income, known as ATI, plus interest income. So if you're getting interest income, the government allows you to have interest expense of the same amount because you're a lender and a borrower. So that's kind of the kicker there. But the main limitation for taxpayers is 30% of adjusted taxable income. That is defined as taxable income before net interest expense. So before your interest, so you got to get back to a pre-interest number, taxes, depreciation, and amortization. Most people say that's EBITDA. So you'll hear people talk about 30% of EBITDA is the limitation that they're subject to. So interest expense exceeding that 30% limitation may be carried forward indefinitely, awaiting sufficient ATI in those future years. So those of you that are in business entities, we talk about carrybacks and carry forwards. You get to take that attribute and put it in another year. It's only valuable in that next year if you have sufficient ATI that you can deduct 30% of the carry forward number plus that year's number. So you can see where if you're chronically highly leveraged in the eyes of this rule, you could have a snowball effect, right? You can't ever deduct what you have in the current year, plus you got this carryover from the prior years, so the snowball keeps getting bigger and bigger. So effectively, it becomes not deductible, even though the carry forward is indefinite, meaning it can be forever. The only things that change, right? So if I was the VP of tax and the CEO called me again to complain about why do I keep getting these questions about my effective tax rate, I would say the only things that'll make us be able to fully deduct our carry forward interest is my interest expense has to go down as a business, which means we repay debt or we refinance to a lower rate, or my EBITDA goes up. That's not in the control of the tax department, right? You don't tell them that, hey, you got to pay down your debt. You can raise your hand and say, it'd be nice if we paid down some of this debt, but that's a business decision, right? For affecting a lot of parts of this. And you can't control EBITDA, right? That's the operational of the business. But that's the only two variables that can help here in this context. Okay, 1030. I believe this was, anybody want 1030? Come on down. So do this slide and the next slide if you want.
Forco, a foreign corporation, owns 100% of USA Co., a USA subsidiary that derives all of its income from U.S. business operations. Forco also has a creditor interest in USA Co., and USA Co. annually pays interest to Forco of $20 million, all of which is business interest. The results of USA Co.'s operations are as follows. They had gross profit of $60 million, interest income of $2 million, and then less interest expense of $20 million, depreciation expense of $10 million, And then other operating expenses of 27 million, which left them with a pre-tax income of 5 million.
So we're gonna get to the base for which we can take 20%, that ATI number. I put in the bubble here, the One Big Beautiful Bill Act of 25 restored the DA. That's what it was called when corporate America was lobbying Congress to change this rule, was restore the DA. It used to be EBITDA, then we had a couple years where the DA fell off because of the law when they passed it in 2017, took away the DA, I believe after 22. And so the government restored the DA retroactively back to January 1 of 25. So what did that do? We're looking to increase the base, right, of which we can take 30%. So if the government increased the things that we add back, because it's earnings before, so we get to add things back, that's a good thing. So this was a big deal for corporate America. And you'll see when I change the example in 1030, it's because the authors haven't yet updated the example for the retroactive restoration of the DA. Okay, go ahead.
USA Code's adjusted taxable income is 33 million, which is 5 million of pre-tax income plus 18 million of net interest expense, and then 10 million of depreciation.
So that's my add backs to that 5 million of pre-tax income. I get my net interest expense of 18 million, and now I get the DA, depreciation and amortization, added back. If I didn't get the DA, if they didn't change this back in the One Big Beautiful Bill Act, I would have had $10 million less. That's what the red line is in this example. I'd have a much lower ATI base. Okay.
So USA Code can deduct a total of 11.9 million of interest expense, which is comprised of 9.9 million, 30% of 33 million, and then plus $2 million of interest income.
So the retroactive application increased an additional 3 million of deductible interest expense because the DA was added back, was 10 million times 30% limitation. So I effectively got a $33 million current year deduction that I wouldn't have gotten absent the One Big Beautiful Bill Act. And then down at the bottom here, you see the 8.1 million disallowed. That's the amount of interest expense that I incurred that I didn't get to deduct. That's the carry forward. So think about that. That goes into next year's computation. I start off day one of 8.1 million of interest expense, plus I got that year's interest expense. So that's where the snowball effect can happen. If your facts don't change, EBITDA goes up or debt goes down, you're really kind of stuck in this limitation, and it can be pretty painful. Okay, thank you. Okay, so that's the interest expense limitation. Applies broadly to everyone. But it's in particular, I put it here in our inbound scenario because we still have a lot of inbound investors that will finance the U.S. with debt. So it's very common to see there, and plus it's got a long history of debt financing. So our last topic is the BEAT. Okay, this is a function. Remember, guilty, and the drafters of the legislation in 2017 picked the name of the legislation to fit a nice, catchy acronym. So guilty was global, intangible, low-taxed income. BEAT is base erosion anti-abuse tax. I think this was completely unfortunate, but the idea was the taxpayer was bad and they were beating the taxpayer. That's the rationale. I think we've gotten away from that, but at least that's people that were drafters back then, that's what they did. So the BEAT regime started in 2017 as part of that Tax Cuts and Jobs Act. The important thing to think about with BEAT is 163J, what we just talked about, only applies to interest. So a taxpayer could say, oh, well, I don't want to do interest because I'm going to be subject to that limitation. But I remember that first example that we started with today, if I could get any other type of deductible payment, I'm not in 163J. What if I pay a royalty? Interest expense is only covered in 163J, not royalty expense. I get the same net effect of a repatriation from the U.S. via deductible payment. Interest is not the only deductible payment that's out there. Okay? So, in contrast to the 163J focus on interest expense, BEAT focuses on many types of deductible payments. So it's a new regime. 163J has been around for decades. We have this since 2017, and it's trying to fill in a gap saying, okay, we got a limitation on interest expense, but I'm worried about all deductible payments that are from a foreign parent, or from the U.S. to a foreign parent. So focuses on much broader degree of payments, and the U.S. subsidiary may make, and that a U.S. subsidiary may make to a foreign related party. Usually it's a foreign parent. So remember I said 163J can apply to all interest expense. This applies to much broader types of deductible payments, but I have to make it to my foreign parent. If I make one of these types of payments we're going to talk about to an unrelated party, it's outside of this regime. Only covers the payments that are going to a foreign party. Okay? And by making high amounts of deductible payments to a foreign related party, a U.S. subsidiary can reduce its corporate income tax liability just like it. So I always kind of feel like BEAT was trying to fill in a gap that was perceived there because we dealt with interest expense. We needed something else to deal with other deductible interest or deductible expenses. And BEAT does not apply to payments to unrelated parties. 163J only applies, or 163J applies to all parties. Okay, 1032, I believe this is Shihan.
Alright, so this example, we have a foreign corporation, Forco, that owns a 100% of a US subsidiary, US sub. So US sub earns 300 million in gross profit, but what they do is that they pay 280 million royalty to the foreign parent. And since we know royalties are normally deductible, US sub's taxable income falls to only around 20 million, and then after the 21% tax rate, that's only 4.2 million out of the 300 million gross profit. So this is a concern U.S. government's facing. So that the profits can pretty much effectively what they're doing is that they're shifting profit away from the U.S. to a foreign, to a foreign country. So that's why BEAT was enacted in 2017, which was the strategy. So they can get their reasonable share of the tax.
Exactly right. Good observation. So. Couple of thoughts here. I first have to, I can't just pay a royalty to somebody, right? I can't just like say I'm automatically going to pay you a royalty. There has to be a transaction first, which is a license of intangible property for which I use, and then in exchange for that use, I compensate you via a royalty, okay? So just like I can't just start paying interest expense to somebody, there's got to be a loan that then has to be serviced with interest expense. Just keep in mind that I have to have first in advance or access to intellectual property before I can charge a royalty. But assuming that's here, and assuming the royalty rate is arm's length, because again, the government can come in and you could say it's a royalty, but the government can say, I don't believe that's a royalty. I don't think that seems like an excessive payment. I think the rate's too high. I can adjust that rate back down to what an arm's length person would provide access to a similar piece of intangible property. So just keep that in mind. So this is a pretty egregious example because I had 300 million of taxable income and I took a royalty out of 280 million. You're probably going to get the scrutiny of the IRS on that because we have very little taxable income behind. And so this is what BEAT was addressed at. It was focused on is base erosion, anti-abuse. So the idea was you're providing the U.S. deductible payments or over repatriating your U.S. taxable income via deductible payments. BEAT is thought of as a minimum tax regime because you'll see here we're going to set you up, as Chiha was alluding to pay a minimum amount of tax on the U.S. Okay. Importantly, BEAT only applies to large corporations. Those are defined as those with both average 500 million of gross receipts the previous 3 years. So we're talking about big corporations. These are not mom and pop organizations that are not going to be subject to BEAT. And they had to have a base erosion percentage of greater than 3%. And that's measuring your base erosion payments divided by all your deductible payments. So they're trying to, that second prong is trying to say, how much of these payments are you paying to your related party? Because that's what we want to focus on. Big corporations who are paying too much deductible payments relative to their total deductible payment to a foreign related party. And they chose 3% as being the proxy for that. A very objective test. Okay, 10.3.6. Katie?
So a foreign corporation wholly owns a U.S. subsidiary, which has averaged over 500 million of gross receipts in the last previous 3 years. USUB incurs 100 million of deductible payments, of which 3.5 million are the base erosion payments.
So let me pause you there. So it paid 100 million of deductible payments. So just on its tax return, that whole section of expenses, there was 100 million, and 3.5 of that 100 million went to its foreign parent. The rest went to all the other, unrelated parties that it deals with throughout the year.
Because these base erosion payments constitute more than 3% and 3.5% of deductible payments to be applied.
So this doesn't mean that you pay BEAT. So it's a tax liability. So this is an extra tax. Just trying to get to a minimum tax here. We'll talk about how that applies in a moment. But it says you have to test for that. So you're a large corporation, greater than 500 million average gross receipts. Gross receipts, yes. And then you paid a disproportionate amount, greater than 3% to your foreign parent group. That causes you to be in the front door of the BEAT. Okay. Perfect. Thank you. Okay. So you can see I'm either in the front door or I'm not, right? So that 3% test is pretty important. So regulations permit a taxpayer to waive a deduction to avoid being subject to BEAT. So we did this for several clients. If you were just over that 3% threshold, you could fall below that 3% threshold by waiving a deduction. And importantly, that's waiving it for all purposes of the code. You have to not deduct that, again, arriving at taxable income. I pull you out of BEAT, but you also lose the deduction for the payment. Okay, so 1037 is Jihad.
So same, so this is like a continuation of last example. So we know that their base erosion percentage is above the 3% threshold, meaning that BEAT would apply. So what USF can do is that we can waive 1 million of the payments from the deductible payments. So that would decrease their payments to 99 million. And then the base erosion percentage is only 2.52%, which is below the 3% threshold. So what they're doing right here is that they would have 1 million more of taxable income, but they also avoided the BEAT tax.
Yeah, and I think this is part and parcel because this is a cliff effect. If you go to 3, you're in the rule. If you're 2.999, you're not in the rule. So the concern was when they were drafting this, people said, okay, should $1, the most extreme example of a payment, make the difference between being in the regime or out of the regime? So the government said, okay, the way you could deal with that is in that extreme example, you could waive a deduction for that $1 and fall to the 2.999%, okay, to get out of the rule. Now, importantly, at the very end of this, but US sub would have 1 million more of taxable income. So this wasn't the extreme example. I had to waive they gave themselves a little buffer because they went down to 2.52%. You don't need to go down farther. You just got to be below 3. But whatever that number is, however big that number is, you do lose the tax deduction for that number. You waive it for all purposes of the code. So you can imagine this is a modeling exercise. When we get to how much BEAT would I owe, I compare that with how much does this cost me from a taxable income perspective to waive this deduction for all purposes of the code. Does that make sense for me? Or do I just go ahead and be in BEAT and pay BEAT? So it's not the end of the world to be in BEAT, it's just how bad does it affect my tax liability. Okay. So the calculation details. Think of this as a minimum tax. This is going to be important for you, for those of you that are in advance as well next half semester. Is because this is one of the bargaining chips that we use when we talk to the OECD. It's about this. We already have a minimum tax. It doesn't work like the OECD wants it to work, but it does work, okay? So think of it as a minimum tax for a U.S. subsidiary corporation that makes significant deductible payments to a foreign parent company. The BEAT rate is 10.5% in 26, which increased from 25 at 10%. So from 2018 to 2025, it was 10%. We raised it to 10.5, and it's part of the One Big Beautiful Bill Act. The One Big Beautiful Bill Act didn't do a whole lot to the BEAT regime, but it did impact that number. And you say, oh, well, it raised it from 10 to 10.5, but it would have went to 12.5 absent the One Big Beautiful Bill Act. The Tax Cuts and Jobs Act had it going up 26 to 12.5. So they pulled that back and it went up just a notch. Okay, okay, so the BEAT rate is 10.5%, and it is applied to modified taxable income, which is then reduced by the U.S. subsidiary's regular income tax liability in order to serve as a minimum tax. So if the way to think about this, those of you that were in individuals, remember when we did alternative minimum tax? We were comparing that to the regular tax. We had to do a separate computation, and I was complaining about having to do so, but you compute your alternative minimum taxable income and apply a different rate to it, and then you compare it to your regular tax. You have to pay the at least the lowest of the two, right? So, at least the highest of the two, sorry. So if your regular tax was higher, then your minimum tax was irrelevant. You still had to do the calculation, but it didn't cost you. If it was higher than your regular tax, then you had to pay the difference. Same thing here. That's what's going on here. You do a separate calculation, so we're doing modified taxable income. Not as difficult as alternative minimum tax on the individual side, but we are doing a separate base, different rate, 10.5%, not 21%, the regular tax rate. So we compare that to our regular tax liability. If BEAT is below regular tax liability, you're done. If BEAT is above, you got to pay the delta. Serves as a minimum tax. Okay? So just because you're in the BEAT rules doesn't mean you have $1 more of income. Okay? You may be wildly taxable and pay plenty of regular tax, and this doesn't affect you. But if you don't pay a significant amount of regular tax, then you might have a top-off taxable. Okay, so modified tax, yeah, George.
Previous slide.
Correct.
Once the income pays tax returns,
Yeah, so what you would do here is you'd have your tax return done, and you would do your BEAT calculation, and then you would say, okay, how much do I pay in BEAT, which is incremental to my regular tax? And then I compare that to the cost of waiving some deductions to pull myself below that 3% threshold and get out of the rule. Because I could be way into BEAT. What if my base erosion percentage is 6? That might be a significant waiver of deductions to get below 3. That's going to cost me a lot of taxable income. That may be more costly than paying the BEAT incremental tax. Just a modeling exercise. So my one client that was really caught in BEAT, we did this modeling all the time about waiving deductions. Okay, so modified taxable income is what we got to get to. That's simply taxable income without any deductions for payments to foreign related parties. So it's easier than the individual AMT where we had all those adjustments that we had to do to taxable income to get to alternative minimum taxable income. This, all we gotta do is we gotta add back our deductible payments to our related parties. And base erosion payments, so those payments that are from the US to a foreign related party, broadly defined, includes rents, royalties, interest, some service fees that are not subject to withholding tax, and payments for the purchase of depreciable property but not inventory. So very broadly written. So even the purchase of a hard asset, like a tangible asset that you're gonna, piece of machinery, foreign parent uses it in their business, the sub's gonna now use it in their business, so they pay arm's length price for it. The reason that is a base erosion payment is what are we gonna do? When the US company buys that piece of equipment, we're gonna set it up, as you guys know who are in business entities, you're gonna set it up on depreciation. Depreciation is a deduction in arriving at taxable income. So the US was also cognizant of, it's not just a deductible payment, it's a payment for a tangible asset that is now gonna give rise to depreciation expense. So any payment that is reducing taxable income to a foreign related party likely is gonna fall within a base erosion. I put in the bubble here, the interest expense limitations of 163J are applied before the application of B. So that's to focus B on deductible interest expense. Okay, so even though I have a 163J limit, 30% of EBITDA focused on interest expense, whatever is deductible then has to run through the BEAT calculation. Okay, so even a highly leveraged company might still have to have a BEAT liability. So we're talking about deductible interest expense. So one, the way I like to think about interest expense is, first it's got to be on real debt, that debt versus equity determination. The interest expense has got to be arm's length. Then it's got to be deductible to 30% of ATI. Then it's got to get through BEAT. Why is that? Because the government thinks interest expense is so simple to do, right? Anytime the US subsidiary needs money, you can lend them money, have them pay you with interest. Okay. All right. With respect to payments for services, so if it's a service payment from the US to the foreign group, the amount of the base erosion payment is the entire fee. However, in the case of low margin services, the base erosion payment is only the markup portion and not the entire fee. So when the government was designing this regime in 2017, it was all service payments, and then some people said, hey, what about like just back office services that are done by the foreign group for the worldwide group, and I pay that. That might be a big number, but it's low margin, right? It's just like, okay, I'm paying for treasury services, whatever, paying for IT services or something to the foreign parent group. That if you take the entire fee, then that's an outsized base erosion payment compared to a true value-added fee that might be more substantive, like a management fee or a home office fee for more strategic decisions. Okay, 10.3.2 is 10.3 Genevieve? Okay, sorry.
Forco wholly owns US sub. Forco provides US sub with payroll services. The cost of providing the payroll service is $800,000 that Forco marks up by $40,000, below 5% markup for a total service fee of $840,000, and only the $40,000 markup constitutes a base.
So this is just for that dynamic I was just talking about. If we were held to, there was no low margin service rule, then my total base erosion payment would have been $800,000. But the government's saying, okay, that's for payroll. That's just regular routine low margin work. So we're only going to count the markup portion, the $40,000, as being within the base erosion. Okay, perfect. Thank you. Okay, 1033. Favorite. So this is the end result of the. Okay, so you're above the 3% threshold, and you're starting to now, do I actually owe incremental tax by virtue of being in this? Okay.
So as in the previous example, Forco wholly owns US sub.
After deducting a $280 million royalty paid to Forco, US Sub has $20 million of taxable income. Regular corporate income tax liability is $4.2 million, 21% of $20 million. The B is $27.3 million, computed as 10.5% of $300 million for $31.5 million. The royalties is not deductible for B purposes. Less the regular corporate income tax liability of $4.2 million, the total US tax is $31.5 million. $27.3 million of B plus $4.2 million of income.
So I put in the box there summarizing that calculation that Genevieve just went through. So taxable income was 20, vastly reduced by that royalty payment in that prior example. So I have to add back that base erosion payment to get to my modified taxable income of $300 million. And then I apply this relatively low rate of tax of 10.3%. So the government wants to see me pay at that US sub level, $31.4 million. Well, I already paid 4.2 of regular tax, but that means I owe an incremental amount of 27.3. That is my B liability. Okay, that's my minimum tax. So it's made me make an extra payment to the U.S. government by virtue of base eroding excessively, if you will, for the royalty. Okay, perfect. Thank you. Okay, so Chapter 10, we covered the taxability of foreign-owned businesses. That was all about the threshold at which you can do activities in the United States before you become taxable. Remember, that's in a treaty context and a non-treaty context. Treaty context is a higher threshold. You need to do more things before you become taxable. Then we had the branch profits tax. That's varying the withholding tax implications of choosing to do business in the United States in branch form, so that your repatriation comes out as a distribution from a branch, which is not subject to withholding tax, as opposed to if you did it via corporation, your same distribution would have been a dividend, maybe subject to withholding tax. So branch profit tax tries to equate those two operating models. And then we did interest expense limitations and base erosion and reduced tax. Okay? These are the hot button issues for inbound investment. Affects all the giant inbound corporations. Okay, I thought we could spend a few minutes talking about review topics. We'll do expense sourcing, LTOB2, and FTC 3. Okay, so let's do expense sourcing. That is going to be in Chapter 3. Okay. So expense sourcing. Why is that important? Because we got to get to net foreign source income. That's our multiplicand in the foreign tax credit. That's our outbound investor, right? U.S. investing abroad, likely to pay host country tax. How much can I credit against my U.S. tax liability? Because the U.S. is taxing us on a worldwide basis. I need to know my net foreign source income. So I got to source all my gross income, and I got to apportion my interest expense against it to get to the net number. Okay? The second sub-bullet here, a foreign person with effectively connected income needs to source both its income and expenses to arrive at U.S. source taxable income. An inbound investment we just went through in Chapter 10, what if the investment is via a branch? I need to know what income is properly attributable to that branch. And it's got to be net income because I get taxable income less my expenses on my tax return. So the sourcing rules is important for FTC limitation and inbound net taxable income calculation. Okay. And in computing these amounts, the taxpayer can deduct expenses and losses directly related. Think about that as allocation. So this expense drives that income. That's where I put that expense. Or if it relates to multiple categories of income, then I have to apportion it. I spread it across those things. This example is the one I like to depict that, right? So the services income in the top rectangle, I have technicians who drive the services income, right? So their salaries of $500,000 directly relate to the $800,000 service income. That's an allocation, direct relationship, leaving 88 minus, then the rent, the green arrow, rent applies to all the categories of income. That gets apportioned in this example based on relative gross incomes. So I send 80,000 to the services line of business, leaving 220,000 of net income for services. Okay. The salespeople salary goes against that, directly allocated. The 20,000 of rent is their portion of the apportionment, leaving 50,000 for sales. Okay. So that's the way I like to think of allocations. Is it solely related to that? Then I hit it with that. If it's spread across them, then I have to pick an apportionment. Okay. These next examples are just picking the right apportionment key. Right. I have a lot of flexibility for expenses that don't have a specific rule, which we're going to go through in a moment. I want you to know interest expense and R&D. But everything else is just apportioned, and I can pick the key. So there's various examples about picking gross income, picking sales, and depending on those, which one gives me the right result, I can maybe build my facts around that's the appropriate apportionment. I can't just use the one that has the best answer. I have to have a factual reason why I think that makes the most sense. And if I'm working for or on behalf of a outbound investor, so I'm trying to drive up foreign source income, I probably want to have the apportionment key, all other things being equal, that is sending expenses more apportioned against U.S. sources rather than foreign. Why? Because I want net foreign source income higher. That's my FTC limitation. So I have some degree of flexibility on determining my apportionment. So on slide 47, I do have specific apportionment rules for interest expense. Okay, just like we just talked about earlier, the government always thinks interest is special, and the reason being is because interest is relatively fungible. I can choose where to put interest expense in my group. I could get the bank to lend me money, and I say lend it here in my group. For this particular purpose. And so by virtue of choosing that, that frees up cash elsewhere. So the fungibility of money means that the U.S. is very focused on having specific rules for apportioning interest expense between U.S. sources and foreign. Okay. And down here at the last bullet, it's based on assets. I can't do interest expense based on gross income or gross sales. I can't choose my apportionment key. It's specific. These rules are specific. The government dictates how interest expense must be apportioned. And it's based on assets, and that's regardless of the jurisdiction of the borrower or the specific purpose of the borrower. So if I borrow money to build a plant in St. Louis, that does not make the interest expense U.S. source. Because I'm going to look at my assets globally. Spread it around based on all my assets. Okay, and it's only one way. Okay, I think this next example. So the interest expense that's on the U.S. tax return is what gets apportioned. Okay, so this example stands for the proposition that I have interest expense at the foreign subsidiary level, i.e. it's borrowed from a bank. That interest expense never gets apportioned up to U.S. sources. In effect, it's been completely apportioned to foreign source income because it's addressing, the only place for it to go is against foreign sub earnings. So it's a one-way street. Next example, I do take US interest expense and apportion it between the US and foreign businesses based on gross assets. I do apportion down. That's been a complaint about the apportionment of interest expenses. It's a one-way street. I don't get the benefit of my foreign subsidiaries borrowing. Remember, I made the point that this is largely not that huge of an issue for taxpayers because many U.S. Parented groups, they borrow all their money in the U.S. Because the treasurer sits in the U.S., the banking relationships reside in the U.S., so it's just a natural function that the borrowings are in the U.S. But you still do not get the benefit of your foreign subsidiaries if they have external borrowings as well. Okay, so that's it. So I would look at all my interest expense, take my U.S. debt, and then if it's partially U.S., partially foreign, that's my interest expense apportionment. And that's largely going to be the driver for my foreign tax credit position for U.S. The other specific apportionment rule is R&E. Sometimes it's called R&D, research and experimentation, or research and development, same thing. But R&E expenses are, again, I don't get to choose the allocation key. Government prescribes what happens here. So the R&E expenses are first allocated to the gross income of each product category based on a 3-digit zip code. And second, R&E expenses are apportioned between U.S. and foreign sources using the sales method. Under that sales method, if I perform more than half of the R&E activities in any particular country, the taxpayer apportions 50% of the R&E expense to that geographic source. If I'm doing it in the U.S., that's where my white lab coats are, then 50% of the R&E goes to the U.S. That remaining 50% is split, i.e. apportioned between U.S. and foreign, based on U.S. versus foreign sales, hence the sales method. Okay. Very prescriptive. If I have anything else, SG&A, rent, all that stuff is just, I got to pick an apportionment key. I have flexibility in building the case. Stewardship expenses are the expenses of the U.S. parent. Think of the headquarters. Think of the giant office buildings where the headquarters are and all the people that are working there. That massive expense that's there, there's a portion of that that is considered stewardship in the eyes of the tax code. Stewardship is, think of, it's a duplicative expense. So as a shareholder in a foreign subsidiary corporation, you might review their budgets, you might review their strategic agenda, their strategic profile for the future, and that is really duplicative in nature, right? Because the subsidiary is already doing their budget, they're already doing their financial statements, you're reviewing that as a second set of eyes, you're doing that in your capacity as a shareholder. That stewardship expense needs to be apportioned between U.S. and foreign sources. And so the area here is, the large portion of that can be considered foreign if you're doing that for your U.S. and your foreign operations. And trying to build your fact pattern as to why you're choosing your allocation key. Many corporations do this based on time spent. And the only way you can get an accurate number on that is you talk to people. People that are reviewing the budgets. How much of your time do you spend reviewing U.S. budgets versus foreign budgets? And really trying to hone in on that and not coloring the facts to favor you one way or the other, but just make sure you get a really concise view. Do you really do that much globally? Or do you really do more on the U.S. side? Again, if you're trying to deal with your foreign tax credit, you want to skew towards the U.S. apportionment of expenses. Like that multiple. Okay, so that's sourcing. Okay. So sourcing of income, right? You got to go just tumble down by the income items. Each one's got a specific rule. What am I dealing with? The biggest hard headaches there is inventory. Right? So purchase inventory has a different rule from produced inventory. Purchase inventory is where title passes. Where does ownership change hands? Manufactured inventory, produced inventory is place of production. You have royalties, you have services. All those things have a rule. So you've got to, those are probably probably weren't writing them down. Okay, let's go to the anti-deferral stuff, chapter 5. Let's go to start with the guilty. Okay, so just as an aside, remember we started with subpart F. Our general rule is deferral. We do not tax the foreign corporate subsidiary earnings until they make a distribution to the United States. We do have anti-deferral regimes, the longest standing one of which is subpart F, but it's focused on transactions and types of income. It doesn't take a holistic view of all the income. It's just like, is your income passive in nature, that foreign personal holding company income, dividends, interest, rents, and royalties, or passive income flows, or is it more active flows but generated via a related party? Foreign-based company sales income, foreign-based company services income. So you just got to blast through that. So then we had GILTI came along in the Tax Cuts and Jobs Act of Trump 1.0, and it's applicable from 2018 to 25. It is not focused on types of transactions, right? Its whole focus was to try to hone in on a proxy for what is intangible income. And that intangible income is what the U.S. would reach down into the foreign subsidiary and tax currently, irrespective of a dividend distribution. Anti-deferral. So we're not waiting for a dividend of this activity. And the premise for this was a disincentive to move intangibles from the United States. Like during 2022, don't move your intangible from the United States to your foreign subsidiary because I'm going to tax that earnings. Or if you did it in the past, now I'm going to tax those earnings, i.e. you are guilty of doing it in the past. That's the premise of this regime. Okay, and the whole thing here is, remember I like the dichotomy of routine earnings versus non-routine earnings? Routine earnings is that 10% on tangible assets. Government wasn't going to debate you subjectively as to what is intangible income versus non-intangible income. We're just going to say 10% of your tangible assets is a routine return, i.e. non-intangible. Everything else must come from intangibles. Okay? And that's what we're going to tax. Global, intangible, low-taxed income. Okay? It applies to CFC, so you need to know what is a CFC and what is not. Right? Because if it's not a CFC, you're not in subpart F, you're not in GILTI, you're not in net CFC tested income. If you are a CFC, you're in all three. Okay? And so you need to know how you do net tested income and net deemed tangible asset return. Okay? Lots of terminology, but not that difficult to get through once you start there. So subpart F applies before GILTI, so subpart F is excluded from tested income. Right? If you're building the second regime and you're trying to do anti-deferral, if one regime, the first regime already picks it up, you don't need to address it again. Income's already taxed, right? So if subpart F picks it up, you're outside of GILTI because we already got it. Now, then tested income includes all other income besides that, and foreign taxes and allocable expense in arriving at tested income. Okay, so we got tested income, which is the real trick on tested income is this example A on the slides here. CFC 1 had 10 million of tested income. CFC had 5 million of tested loss. The parent has net CFC tested income of the combination of the two, 5 million. Right? So I'm doing this on a global basis of all of my CFCs. I do get the offset of the tested loss against my tested income. And then the whole thing is my deemed tangible income, which is 10% of qualified business investment QBI. And that's my tangible assets as computed average of my 4 quarterly balances of that. But then I get that deemed 10% return. Everything else now comprises of my net deemed of my intangible return. Right after I carve out my return on my tangible assets. And then I think if you just work through these examples, you're going to get to the amount that is taxed. Calculation of that is the 10%. Once you get to 10% on the tangibles, that reduces your net taxable, your net tested income. That is times the guilty inclusion that you have in the U.S. Now, keep in mind you do get a deemed paid credit because you're going to pay tax in the foreign country, right? We're talking about a foreign corporation. It's going to pay tax in the host country, so you do get a deemed paid credit, and there is the deduction for 50% of the guilty inclusion. Okay, so whatever you include, we don't tax it at 21 because we're going to give you a 50% deduction for that. So effectively, that's the 10.5% rate that we're looking for on that tax or on that type of income. So I like to think of guilty as, yes, it is an anti-deferral inclusion, but we don't tax it as heavily as we could if it was earned in the United States. If I had done that same activity in Missouri, I'd have paid tax at 21%. There is no 50% deduction for U.S. taxable income. So it's a compromise that the U.S. wants to have it as a minimum tax, but we want to tax some of it, but not as heavily as we would if it was in the United States. That's kind of the compromise. Now, so the big thing, the criticisms of the guilty regime is that 10% tangible return. Remember the oddity that when you think about that, you're like, are you really wanting me to put my tangible assets offshore? You want me to build my next factory in Mexico instead of the United States? It doesn't seem what I hear when I listen to the State of the Union address. That doesn't seem like what you guys want. And so that was an oddity that they fixed when we're now going to go into the net CFC tested income regime, which is after starting in January 1 and 26, One Big Beautiful Bill Act change. And the other criticism was that we did apportion shareholder level expenses against this income. So if I take U.S. interest expense, which is a big problem, and I apportion that amongst all of my foreign tax credit limitations, remember I have 4 baskets, one of them which is guilty, then that 10.5%, which is the half, the portion of the tax base that's taxed half of the U.S., because I get a net deduction of 50, it's not really 10.5 because you're making that number lower. You're lowering my interest or my foreign tax credit limitation because you're burdening it with expense apportionment from the United States. That was the complaint of corporate America. So what got fixed when we went to the net CFC tested income regime beginning in 26? No more proxy for intangible income. You don't get a deduction for 10% of your tangible assets, removing that oddity of, please do build your factory in Missouri instead of Mexico. Right? We're not going to try to work against that general premise. And the full amount then becomes taxable in the U.S., but the big benefit for corporate America was they stopped requiring the apportionment of shareholder level expenses against this category of income. So now it's a true minimum tax. Instead of artificially lowering the amount I can credit by burdening it with apportionment of expenses. So what remains to be seen, but most of corporate America is saying, now I won't be in an excess credit in this basket. Which is, again, think of corporations. Right at the start when we started the course, remember I was trying to insert another slice of the pie in there? So the US is not opposed to sharing corporations are not opposed to sharing the tax amongst multiple jurisdictions. They just don't want to pay tax in multiple jurisdictions on the same income. And excess credits mean that exactly what you did. You paid tax in a country, you couldn't credit it against the United States, so you ended up paying more US tax. Okay. So that was a big benefit for taxpayers. You still get the deemed paid foreign tax credit because you're going to pay tax in the foreign country just like you did under GILTI, right? And now you only get a 40% reduction. That was one of the bad guys from this. You don't get all good guys, so they did haircut from the 50% deduction was lowered to 40, so that's going to be more inclusion that's there. And then work through that comprehensive in CPI. Okay? That was fast, but I think if you go through and you don't get bogged down in the details and just kind of see if you can piece together the different regimes, I think it'll help make sense for you as you get to Monday. Questions? Okay, between now and Monday, feel free to shoot me an email if you got any questions or you get stuck on something or something still doesn't make sense to you, and we'll knock it out between now and then. Okay? All right. Thank you. Somebody have a sign-in sheet?
Yeah, well, they never makes it to the middle.
Yeah, they forget about us. Yeah.
Regardless, whatever the second like some of them, obviously some of them. Are you gonna take the exam in here?
No, I'm going to
It's so much easier because I like have a lot of the technology stuff already down.
All right, we'll go look.
Yeah, I can't
Taking like right now.
yeah.
Here's my cheat sheet. Okay, I'll see you. Good luck with you.
Yeah, I didn't really look at it, review it, but.
Good luck.
这个我是真是我看都看不明白，这个真的只能自己看。
我感觉死性路也是，就换个人根本看不懂写的。你看上能看懂。
我的个妈呀，怎么这么小？我觉得我这还有很大进步。
我也觉得我有很大的进步。
我昨天晚上做梦都是老师。不考。
看吧，不考试啊，咱们都在讲课。
How we feeling, George?
我这儿吧，
How you feeling?
如果
Think about it.
还就cheat sheet.
No, it's not.
Yeah. full-time MBA.
Yeah. That would come up, people would be like,
Yeah. It's pretty easy to read too.
我看小红书。